Indiacharts, the truth about the markets.
Indiacharts publishes Nifty daily video updates, the weekly Elliott Wave outlook, and the long-short report covering all asset classes.
Welcome everyone. This is the third week of May. Several important events have gone us by, like the Federal Reserve meeting last week, the ECB's announcement on interest rates. I've just published the Weekend with Indiacharts episode 101. So if you have never really watched the Weekend with Indiacharts, I think it's a great learning exercise, a discussion, deep dive into how markets are behaving, what are the different factors affecting it, and how we should really view them. And of course, using charts to overlay everything from macro, currencies, dollar, and how everything is playing around the market direction. So that's a good place to really start. If you want to still see a discussion live on Nifty, S&P, gold, USD, INR, currencies, commodities, then that's with Forex Analytics on 11th. That is Thursday of this week, 5:30 p.m. India time. I would be doing a live webinar with Dale Pinkert at Forex Analytics. So they usually start at 5:30. Most probably I should show up at 6. They start with their own market discussion, and then it would be half an hour to 40 minutes discussion with me, which you can watch out there. So you need to register. If you're on the mailing list, you've got the email from me. If you're on Twitter, you can see the link over there. And if nothing else, just go to the Forex Analytics website and register for their webinars, and you'll start getting notifications about it. So that's what you'll need to do. So those are the events to watch out for, but never miss out on the Weekend with Indiacharts to update yourself on what is really happening around markets. Now, having said that, what did we really get last week? The Fed raising rates, giving signs and hopes that yes, we are finally reaching the end of the road. But of course, not being committal, just like the RBI, they were not committal. The interesting part was the ECB really slowing down their rate hikes, because ECB Europe really has much higher rates of inflation than the US. At least we've seen some drawdown in the inflation rate. In Europe, we are still to see that drawdown. The rates are much higher, and for them to really cut down on the pace of rate hikes from 50 basis points to 25 basis points to me is slightly surprising, because I thought they would maintain that pace. Now, probably they don't want the euro to strengthen too fast, but the fact is you're out to be fighting that inflation animal in Europe more than the US right now, because the difference between the real rate, basically the difference between inflation and the interest rate, is far wider and very wide in Europe than the United States of America. So that is the situation at the end of the week. But what really plagued markets, because the announcement around the potential pause and maybe eventual reversal of US interest rates, if not now, maybe in 6 months, is somewhat of a positive. But markets were really worried about the US banking sector, which has been impacted by this fast pace of rate hikes, especially when banks have mostly parked their money in treasuries at much lower yields. So they're actually looking at M2M losses, but actually even that's not the problem, because that was the SVB problem, right? The real problem that is being touted right now is that public depositors are finally realizing that they are not getting high yields in the banks, and they can actually move their money to money market funds or short-term treasuries and get a much higher yield. They can get 4 to 5%, and that is sort of causing some kind of cash outflow from banks. But again, it's not like that one-time big jump we saw, which had to be funded after the SVB collapse. When the Fed really opened up its window, we saw $200-300 billion move out. We are not really seeing that pace anymore. But definitely, there was a chart floating around of how much money has been going into money market funds, and in 2 weeks, around $100 billion went there. And so that is being cited as a reason of stress for banking, and that's showing up in probably some short-term bond sales for liquidity, which is why the 1-month bond yield actually jumped very sharply over the week, and specifically on Friday by 100 basis points, which got cited as something is wrong in the system. I guess it's essentially this, that if people are moving money, and who's moving money? I mean, it's not the small depositors. They really need to keep funds for their usual time-to-time expenses. It's only somebody who has a much larger investment profile, has excess funds lying in the bank. So basically large depositors, which typically in a diversified bank would not be more than 10-15% of the total deposits. those are the ones who are really moving money into higher yielding instruments, and that has some impact on the bank's short term liquidity. It really doesn't impact the system as a whole, because what I think, and this is my view, is that if you're really investing in a fund, I mean, it's like if I start investing in mutual funds, as we tell most investors in banks to do, buy mutual funds, buy stocks. Does that mean it's money going out of the bank, and the bank is becoming cash deficient, especially in a country like the United States, where 65% or 60% of savings are really allocated towards equity on a whole basis? Maybe not everybody has the same ratio, but for a country where equity participation is so high, does that mean that money goes out of the banks? And so similarly, if you're saying money is going into a money market fund, you're saying into treasuries or other corporate higher yielding debt, you're essentially shifting money from one source to the other. Either it'll sit with the government in a bank somewhere, or it'll sit with the corporate in a bank somewhere. So money doesn't stay in the cloud, it stays in a bank deposit, one bank or the next bank. And so definitely creates a problem for some banks if too much moves out of it. But if it's a general transfer happening between banks, the net impact won't be that $100 billion that the money market funds are showing. It may be much smaller at the banking level. But having said that, yeah, there is some short-term pressure which is showing up on the 1-month bond. Now, that may alleviate itself. In fact, when I look at the bank index, which is the US, any of the US banking indices, it does look like there's one last, maybe wave structure-wise, fifth wave, last panic sell-off or last spike down before we can start some kind of a meaningful recovery in the banking sector. What will cause that? No idea. It could be anything. It could be maybe one more bank pending to hit the wall. That's already happened with a couple of banks, and it's surely possible one more manages to get there before Fed really pulls the switch on, putting in place some more barriers to that happening. But the real thing, as I was listening to many interviews, is that these bank runs are really based on fear, because what drives banking? Banking is essentially driven by trust. So if you trust the bank, you put deposits there, the bank lends it out, and if it lends it out well, then really makes a return on that, and is in a good position to really repay the funds that it has to, if at all. But of course, the basis of fractional reserve banking is that everybody will not withdraw their deposits at the same time, and therefore if you have made several loans and given out credit, that those credits can really hold on for a long period of time. The only time you have a cash crunch is if too many deposits are withdrawn simultaneously. So when would that happen? Only when you lose trust, when you think that, well, I don't trust this bank, I think they could get into trouble, and a lot of money moves out, and then suddenly there's a deposit shortfall. But is that what is really happening? If people are just investing in other places, they're not really fearing the bank, they're simply looking for higher yield, and money is moving about a bit. And when that happens, it's surely affecting some banks that were wrongly positioned financially, and probably took decisions to either overexpose themselves somewhere. In technical language, we call that asset liability mismanagement of some kind, and that really results in banks getting into trouble. If they do an asset liability mismatch, is essentially when you have debits and credits of different time horizons. For example, if you have short term payments to make, then for that you do short term investments, right? You don't create long term investments to pay short term outflows, and that's sort of what happened with Silicon Valley Bank, where they were, most of their securities were in long-term H2M, and when some of the large depositors, which was their general deposit base, withdrew money, they had to sell long-term bond holdings and book those losses on the hold-to-maturity securities. So that's an asset liability mismatch in the oldest language in finance, and that's something that the RBI or any financial regulator would always tell banks to manage. I mean, that's their main job on the finance side, is to manage the assets and liabilities, and do that by matching the amounts that you might need based on the time horizon. So 1 year securities with 1 year demand, and then you project what your demand would be longer term, and you accordingly invest. So if you have long term loans and you're invested in long term securities, that sort of has a fair match on the both sides of the balance sheet. So that's just a generalization of how you manage assets and liabilities time horizons, and that's what banks have to do so that they don't end up in this soup. So yes, if somebody has mismanaged that, then this kind of a cash rotation can seriously bring out the bad banks versus the good banks, and that's sort of what is happening. So is there one more shoe to drop? Maybe. It's visible on the charts. It could just be, if not one more shoe to drop, it could be one more panic, because what is really happening here is that short sellers have realized that there's an opportunity to make a killing by bringing down the banks. Like I said at the start, this is a game of trust. And you can actually end trust very, very easily if you really speculate against the bank. So if, say, a cartel of short sellers comes together and starts pulling down the bank stock price, people in general watch that price and think something is wrong, and they start moving their funds around, withdrawing deposits, and that sort of has a cataclysmic effect on the bank itself. So the movement of its stock price sort of pushes it to the brink and can cause a bankruptcy even if there was no reason for anything bad to happen. And that is so that kind of a bear attack is something that you really need to save the banks from. So if something like that is really happening, which is also another potential outcome, it's a speculation that's going on, that yes, a lot of the short sellers are finding an opportunity to really sell to these banks and make a profit, and that's something to guard against. And now how are you going to guard against that when it looks like such a big profit opportunity? So it's going to be a tough call unless regulators step in and say, boss, no more short selling of banks. Actually, somebody was messaging me that on our comments on Indiacharts Insiders, that there's a rumor floating around that they'd actually do that. I don't know if they will, but if they do, that could be a blockage for more such cases to happen, simply on the back of creating a fear among depositors, investors in the banks, that something is wrong when actually nothing might be wrong, and then forces a bank run or a closure when nothing should have really happened in the normal routine of affairs. So if that is true, then surely taking such steps can help end that problem for the time being. So that's my take. That's been the main fear. I think the banking sector in the US getting into trouble has been the fear in in investors' minds. And then how will that really impact markets? Now, of course, markets are smart, and that is visible in the intermarket divergence that we see between the S&P and the banking index. So if you look at the Dow Jones Bank Index and you look at the Dow Jones Industrials, one has been hitting 52-week lows since March, and again has done that in the last week. And the other is not doing so. The S&P or the Dow or the Nasdaq, none of them are really making new lows when the bank index makes a new low, and that shows relative strength in the front line in the broad market. Again, maybe not so much in the broad market because the Russell is also underperforming, but of course it's not down there at new lows. But at the same time, it's not really gone up as much as some of the frontline indices. So in that sense, the market doesn't completely believe what is happening here. But at the same time, till it is going on, it is creating fear in the minds of investors that something more unruly can show up at some point of time, and we are definitely scared. So that's what's happening in a nutshell in global equity. Otherwise, things seem to be smoothly moving out from what was an extreme pessimism situation in the month of March to what's starting to look like a slow and steady recovery as far as the Indian stock market is concerned. So we have definitely seen the worst. If I go by sentiment, the short positioning, the amount of puts being traded to calls, and so many other sentiment measures which you'll be able to track on your own completely once you download Strike, which is our new software platform, going to be available in a couple of weeks, maybe even as early as 2 weeks. It will be available for all of you to download and start using, and you'll have access to all market data with proper charts and really being able to scalp through information and news in a much better way than you are doing today across platforms. So that is our promise, and that's what we have spent a lot of time and money building, and you're going to see the first sights of that in the next 2 weeks. So what it shows is, like I said, extreme positioning from which we are recovering. A lot of the shorts have already been covered. In fact, FII shorts are down to zero, and we don't really have much shorts left. But they're not at the other extreme, right? We've seen long positions build up to 60, 90,000 contracts in the last 2 years before we even get a near-term peak in the markets. And we are right now at just plus or minus 10,000, gyrating at that zero line. And so a long way to go. And the same is true even with the volumes of puts traded. It's reducing, but it's not even gone back below the overbought line. The reading this time was the highest on record. That's an all-time high as far as puts versus calls traded. Some of the impact of all this is also because of weekly options. Weekly options, because they're traded every week, square up every week. The number of calls and puts that are being written or bought and sold on a weekly basis has gone up exponentially. In US, you even have daily options, and so volumes there also have exploded, and open interest has exploded, which sort of leads to these ratios getting skewed a little bit. But even then, this was the highest rating on record, which means the most pessimistic extreme, even though markets did not fall that much. From that, we are beginning to recover, and we will have a long way to go before we can actually get the opposite end of the extreme, which is when markets peak, what kind of a reading do we really have? And you can check that out on the strike charts once it is launched. But it takes time, so it's not something which will happen in 2 weeks. That data will get to the bottom end of the range only several months later, is my sense looking at history. And so we are in what I'll call as a post-panic extreme negativity recovery. And a recovery doesn't always mean, so most people say, okay, there were shorts, so there's a short covering rally, and so therefore it is a bear market rally. Well, every bull market starts as a short covering rally. You can go back to the bottom of COVID, 2020. FIs had the max short, SEBI had to actually put a ban on further short sales. And even 6 months later, all the way into June of 2020, when there were no short positions by FIs, the Nifty futures were trading at a discount of 20 points, 30 points, which means somewhere in the system there were shorts, if not FI, somebody else, maybe the client side, maybe individual investors, and so on. And that continued to drive the move. So it's something that takes a prolonged period of time to change, even though it was, like I said, that start of the bull run from 7,000 to 8,000, 9,000 was still on the short side. Eventually, after 10,000, you started to see the bullish trade actually play out more from a positive perspective. It was no more about short covering, but improvement in the underlying economy. And of course, data took its own time. So there was a long lag between data and the markets. And this is the thing to really understand, because there's a lot of data floating around, global equities and so on, the slowdown. But many of these data points are at the extreme negative, which is typically seen at market bottoms. And even then, people are waiting for the fallout of that data to result in something like further recession or one more calamity, one more shoe to drop, one more panic crash. When the data is already at the bottom end and there's nothing worse that you can do to the data. Now, of course, there are other data points which you might feel like labor, right? That's become the central watching point, that, that's really not weakened, and therefore that will be the one that will cause everything to fall apart. Now, like I said, data, for its own reasons, because of the way the economy is being managed, is not behaving in the way it would have behaved in previous cycles. It didn't do that in 2020, 21. So why are we expecting that to do so in 2023? So data can be tricky. What you really look at is the sentiment and market setup, the momentum, and all of that has really shifted from the negative side to the positive side in this month. And so that's the most important thing to pay attention to, that the momentum is changing. When in US equities, I think the last hurdle, which we'll see if we can cross in the month of May, is going to be the 20-month average, because previous bear markets could not really get past that level. And even though the monthly momentum indicator, the RMI, the Rohit momentum indicator, has turned bullish, we still have to cross the 20-month average as a final confirmation that the recovery in US equities is slightly more long lasting. But time-wise, it's definitely, run out of time. I mean, in this much time, the markets would have halved or more in 2008 or in 2000. And we've really not done that. We've started a recovery given the time spent in the decline last year. So a lot of reasons to really think about, why things are improving from here and could get better. In India, of course, we're spending a lot more, 30% more on the capex side, which is why the capex cycle is strong in India. And you can see capital goods sector stocks really doing very, very well. And also, the new favorite, defense, doing very well, and so on. So many sectors doing well, many stocks doing well. The indices have just, moved around on what is happening in particular sectors. Like, for example, IT, one of the major leaders, and large part of the indices was really taking a big hit all of last year, and even now is to show a meaningful recovery. Until that happens, I think that can be a sector that can keep you on the negative side of things. But do you really have to then focus on one sector when there are so many where something is happening? And so this is going to really be a true bottom pickers, market where if you've done the right top bottom up picking, then you do extremely well, which means small and mid cap stocks, I think, are back into positive performance cycles. That's the place where you'll get the biggest moves. Most of the correction in individual stocks looks like done. Even the ones that have been beaten down a lot have started to rally impulsively. So my sense is that situation is improving. You just need to pick the right things is what it's really going to be all about. In short, what I'm really talking about here is that we are looking at a much better market. Things are improving. Most of the negatives are getting priced in, discounted along the way. There are a few more things left. I think they will be done by the end of this month, and we'll have a very clear picture going forward. Having said that, I am trying to work on getting the long short report, the next long short report out. If you haven't read the one that I wrote in March, 14th of March was the last one I published, where I only covered equity. Usually I cover most asset classes, which I'll try to do this time more than I did the last. But that was important because the timing was key over there, that we're getting to the end of the equity selling cycle. Now it's going to look at the entire picture, how it's evolving and what will really drive the market for the next 6 to 9 months all the way into the end of 2023, which is how I think it's going to unfold and what are going to be the driving factors. So we'll get into all of that, and so look forward to the next long short report. And with that, I think I'll end today's podcast and see you all next time. Thank you.
Nothing in this podcast is investment advice. Views on financial markets are in good faith to expand your understanding of how markets work. Please consult a registered financial advisor for the same.
And yes, please share this podcast with everyone you think can benefit from this knowledge.